10 Golden Rules for Intermediate Long-Term Investors. Before we start, let me be clear. This is not financial advice. This is education to help you grow as an investor and make smarter long-term choices. By now, you already know the beginner rules: start early, stay invested, diversify, and control emotions. Those principles don't go away, they're still the foundation. But once you've mastered the basics, the next level is about building strategy, optimizing your returns, and protecting your wealth. These are the 10 golden rules for intermediate long-term investors. Each one builds on what you already know and helps you refine your path toward financial independence. Rule 1. Define your asset allocation. Asset allocation is how you divide your portfolio among stocks, bonds, and other asset classes. Studies show it accounts for more than 90% of long-term portfolio performance. The exact mix depends on your goals, risk tolerance, and time horizon. Historically, a 60-40 portfolio, 60% stocks, 40% bonds, has returned about 8 to 9% annually since 1926, with far less volatility than 100% stocks. But investors with longer time horizons often use an 80-20 mix, which has historically returned closer to 9 to 10% a year. Vanguard research shows that asset allocation decisions matter more than individual stock picking. The action step here is to define your mix. If you're decades away from retirement, lean more heavily into stocks for growth. As you approach retirement, increase bonds for stability. Your allocation is the blueprint that guides every investing decision you make. Rule 2. Diversify globally. Most American investors are overexposed to U.S. stocks, but the U.S. is only about 60% of global market capitalization. International stocks offer exposure to different economies, currencies, and growth opportunities. The MSCI World Index, which includes global stocks, has delivered about 8% annualized returns since its inception, similar to the S&P 500 but with different cycles. There were decades when international markets outperformed the US, the 1980s being a prime example. Between 2000 and 2010, US stocks had a lost decade, with almost no growth, while emerging markets soared. Diversifying globally smooths out these cycles and reduces reliance on a single country's economy. The rule here is clear: don't bet only on America. Use international index funds or ETFs to spread your portfolio across the world. A balanced allocation might be 70% US, 30% international, but tailor it to your goals. Rule 3. Rebalance regularly. Over time, market swings will knock your portfolio out of balance. For example, if stocks rally, your 60-40 portfolio could drift to 70-30ths, exposing you to more risk than you planned. Rebalancing brings it back to your target allocation. Vanguard studies show that rebalancing once or twice a year improves risk-adjusted returns without sacrificing performance. In 2008, rebalancing by selling bonds and buying beaten-down stocks accelerated recovery when markets rebounded. In 2020, the same principle helped disciplined investors ride the fastest bull market in history after the COVID crash. Your action step: pick a schedule. Either rebalance annually or when allocations drift more than 5% from target. Rebalancing forces you to sell high, buy low, and stick to your plan. Rule 4. Optimize for taxes. Taxes quietly eat away at returns if you're not careful. Morningstar found that tax drag can reduce annual returns by 1 to 2% for taxable investors. Over decades, that's hundreds of thousands of dollars lost. Use tax-advantaged accounts like Roth IRAs, 401(k)s, or HSAs whenever possible. In taxable accounts, use asset location. Keep tax-inefficient assets like bonds or REITs in retirement accounts, and tax-efficient index funds in taxable accounts. Harvest tax losses during downturns to offset gains, a strategy used by sophisticated investors to boost after-tax returns. The action step: treat taxes as part of investing strategy, not an afterthought. Every percent you save in taxes compounds just like returns. Be intentional about where you hold each asset. Rule 5. Use bonds strategically. Bonds are not for growth, they're for stability. From 1926 to 2020, US stocks averaged about 10% returns, while long-term government bonds averaged around 5 to 6%. Bonds won't make you rich, but they reduce volatility and provide ballast during downturns. In 2008, while stocks fell more than 50%, high-quality bonds rose, cushioning losses for diversified investors. The classic 60-40 portfolio lost about 30%, but 100% stock portfolios lost more than 50%. That stability makes it easier to stay invested during panics. The action step: Decide how much stability you need. Younger investors might only keep 10 to 20% in bonds, while those nearing retirement might increase to 40% or more. The goal isn't maximum return, it's survivability. Rule 6. Factor exposure. Not all stocks behave the same. Research by Eugene Fama and Kenneth French found that certain factors, like small cap size, value, and momentum, deliver long-term premiums above the market average. For example, small cap stocks have historically returned about 12% annually versus 10% for large caps. Adding a tilt toward value stocks or dividend growers can provide better risk-adjusted returns. Between 2000 and 2010, when the S&P 500 went nowhere, dividend and value stocks still produced gains. Factor investing isn't about speculation, it's about systematically tilting toward proven long-term drivers. Your action step: consider adding small cap or value index funds alongside broad market funds. Don't chase factors blindly, but use them to diversify your sources of return. Rule 7. Smart use of alternatives. Alternatives include REITs, commodities, gold, and even crypto. They can provide diversification, but they're not a replacement for stocks and bonds. For example, REITs returned about 9% annually since the 1970s and add exposure to real estate income streams. Gold, on the other hand, has barely kept up with inflation long-term but shines in times of crisis. Crypto is highly speculative, with extreme volatility. Bitcoin has crashed more than 70% multiple times. A small allocation to alternatives can hedge risks, but overweighting them can destroy your plan. Data shows that portfolios with 5 to 10% in REITs or commodities often reduce volatility without sacrificing returns. The action step: use alternatives sparingly. Think of them as seasoning, not the main dish. A little enhances diversification, but too much overwhelms your portfolio. Rule 8. Protect against inflation. Inflation is the enemy of long-term investors. At just 3% inflation, money loses half its purchasing power in 24 years. If your investments don't outpace inflation, you're going backward. Stocks have historically been the best hedge against inflation, delivering 10% average returns versus long-term inflation of 3%. Treasury inflation-protected securities, TIPS, provide guaranteed inflation adjustments. Real assets like real estate and commodities can also help preserve purchasing power during high inflation periods. The action step: don't sit on cash. Build a portfolio with stocks for growth and add inflation hedging tools like TIPS or real estate. Protecting purchasing power is just as important as growing wealth. Rule 9. Plan for withdrawals and liquidity. Intermediate investors start thinking not just about growing wealth but how to eventually use it. The 4% rule, based on the Trinity study, shows that withdrawing 4% of your portfolio annually has historically lasted 30 years or more in retirement. But sequence of returns risk, retiring during a market crash, can make or break outcomes. Having 1 to 2 years of expenses in cash or short-term bonds creates a buffer. That way, you're not forced to sell stocks at a loss during downturns. Liquidity is also critical for emergencies or opportunities. The action step: don't think only about building wealth. Plan how you'll use it. Create a withdrawal strategy, and keep a cash cushion to ride out volatility. Rule 10. Stick to the strategy, not the headlines. The hardest part of intermediate investing isn't knowledge, it's discipline. Financial media thrives on fear and hype, but reacting to headlines destroys portfolios. In 2020, COVID triggered a 34% drop in just weeks. Investors who panicked and sold missed one of the fastest recoveries in history, as markets hit new highs within months. The same happened in 2022 with inflation and rising rates. Headlines screamed doom, but disciplined investors who stuck to their plan avoided costly mistakes. Data shows that investors who stayed invested through crises consistently outperformed those who tried to react. The action step: create a strategy, write it down, and follow it. When the next crisis hits, don't ask, "What should I do now?" Ask, "Does this fit my long-term plan?" Discipline is the ultimate edge. These are the 10 golden rules for intermediate long-term investors. Define your asset allocation, diversify globally, rebalance regularly, and optimize for taxes. Use bonds for stability, tilt toward proven factors, and use alternatives sparingly. Protect against inflation, plan your withdrawals, and above all, stick to your strategy. At this stage, success is less about learning new tricks and more about refining discipline. The data proves that investors who follow these principles build wealth and keep it. Intermediate investors aren't just planting seeds, they're managing orchards, making sure the trees keep growing strong. And one last reminder, this is not financial advice. This is education to guide your journey.